Downsizing. It's a word that sparks strong emotions. Some see it as a fresh start, while others resist it as a last resort. But what if I told you that for most homeowners, especially retirees, downsizing is not just an option, it's often the smartest financial move you can make? Today, we're exposing the hard truths about home equity release and why selling up and moving to a smaller property can leave you in a far stronger position than any lifetime mortgage ever could. Let's cut through the sales pitches and get to the facts. Imagine this. You're in your 60s, living in a home worth £500,000, mortgage-free. You want to access some of that wealth to fund your retirement. You have two choices. Option 1, home equity release. You take out a lifetime mortgage, borrow, say, £100,000, and let the interest roll up. Over 20 years, that debt could more than triple, leaving your estate with a staggering £300,000 to repay when you pass away or move into care. Option 2, downsizing. You sell your £500,000 home, buy a smaller, more manageable property for £300,000 and pocket £200,000 in cash. Completely tax-free. No compound interest eating away at your wealth. No strings attached. Which sounds smarter? For too many retirees, equity release is marketed as an easy way to free up cash without the hassle of moving. But let's expose the truth. That hassle could save you hundreds of thousands of pounds in the long run. The hidden cost of equity release. Lenders love to tell you that equity release gives you tax-free cash. And while that's technically true, what they don't highlight is that the interest compounds at an alarming rate. In the UK, the average lifetime mortgage interest rate hovers around 6 to 7%. And because it compounds annually, the debt can double in just 10 to 12 years. Let's say Noah and Margaret take out £50,000 through equity release. At 6.5% interest, after 15 years, their debt isn't £50,000, it's closer to £132,000. After 25 years, £239,000. Compare that to downsizing. If they had simply moved to a smaller home, they'd have their £50,000 up front with no escalating debt to worry about. But what about the cost of moving? Estate agent fees, stamp duty, solicitor costs. They add up, right? Yes, but even factoring in those expenses, downsizing remains financially superior in most cases. Why downsizing outperforms equity release? 1. You keep more of your wealth. Equity release locks you into a system where the longer you live, the more you owe. Downsizing, on the other hand, gives you liquid capital you can invest, spend, or pass on to your family. 2. No interest drain. One of the biggest dangers of equity release is the compound interest effect. Downsizing eliminates this entirely. The cash you free up remains 100% yours, no banks dipping into your estate. 3. More control over your assets. With equity release, your options narrow over time. Moving later in life becomes more complicated because your home is tied to a growing debt. By downsizing early, you maintain flexibility, whether that's moving closer to family, switching to a bungalow for accessibility, or relocating to a more desirable area. 4. Reduced living costs. A smaller home often means lower utility bills, reduced maintenance costs, and in many cases, lower council tax. That's money back in your pocket every single month. 5. Inheritance protection. Many people choose equity release thinking they'll still be able to leave an inheritance. The reality? By the time the loan is repaid, there may be little to nothing left for loved ones. With downsizing, your wealth stays intact, giving you the ability to gift money while you're still alive, or pass down a significant estate. Real-life example, the equity release trap. Meet Brian and Susan. In their early 70s, they owned a £600,000 house in Surrey and wanted to access £100,000 for home renovations and travel. They opted for equity release, thinking it was the easiest way to access cash. Fast forward 20 years, Brian has passed away and Susan needs to move into assisted living. The equity release loan has ballooned to £340,000, leaving her with far fewer options. Her family is forced to sell the house to cover the debt, and her children inherit far less than expected. Now, compare this to Fiona, who was in a similar situation but chose to downsize instead. She sold her £600,000 home, bought a £400,000 flat, and had £200,000 in liquid cash. Not only did she avoid interest charges, but she also had the freedom to use the money as she wished, helping her grandchildren with university costs, traveling and living comfortably without financial stress. What about the emotional side of downsizing? One of the biggest objections to downsizing isn't financial. It's emotional. Letting go of a family home can feel like losing a part of yourself. But here's the perspective shift. Downsizing isn't about giving up. It's about setting yourself up for a more secure, fulfilling retirement. Think about the peace of mind that comes with knowing your money is working for you, not against you. No mounting debt, no bank controlling your home, just financial security and freedom. Who should consider downsizing? If you own a home worth significantly more than you need for your lifestyle, want to access cash without losing control of your finances, prefer stability over uncertainty, care about leaving a meaningful inheritance, then downsizing is, without question, the smarter move. When equity release might make sense. Now, are there cases where equity release might be the right fit? Yes, but they're rare. If someone has no desire to leave an inheritance, isn't concerned about growing debt, and wants to stay in their home at all costs, it could be an option, but for the majority, the long-term financial drain outweighs the short-term benefits. The takeaway? Protect your wealth, not the lender's profits. The equity release industry is designed to make money off homeowners who don't realise the long-term impact of their decision. Downsizing isn't always easy, but financially, it's often the safest, smartest choice. If this episode opened your eyes, you won't want to miss what's coming next. There's one more major equity release trap that homeowners keep falling for, and it's costing them even more than compound interest. Want to know what it is? The next video will expose everything. Click on the screen now. And as always, this video is for educational purposes only. Everyone's financial situation is different, so speak with a qualified financial professional before making any big decisions.